Okay, so while most of us were asleep, something really wild happened in the silver market. We're talking about a situation where you have two totally different prices for the exact same thing at the exact same time. It's a paradox, and it points to this massive battle happening right now.
So, let's get into it.
$4.61. That's how much an ounce of silver just cratered in New York. A huge 5% drop, right? On the surface, you might think, okay, just a market correction. But trust me, that's not even close to the full picture.
And then there's this. At the exact same time the price was tanking in the West, someone in Shanghai was willing to pay a $13 premium for that same ounce of silver. We're talking about the biggest gap between East and West pricing anyone's seen in modern history. It's just nuts.
So what is the real price of silver? I mean, how can both of these numbers be true at once? This isn't just a simple price drop, folks. This is a story about two completely separate worlds. The world of paper promises and the world of actual physical metal. And right now, a huge battle is playing out between them. Let's start digging for clues.
Okay, so it all kicked off with this one gigantic trade that happened in the dead of night. And look, this wasn't some normal, everyday transaction. No way. This felt like a move designed specifically to do one thing, not to get a good price for the seller, but to inflict as much damage on the silver price as possible. And the timing here is everything. Just look at this. At 10:40 p.m. Eastern, 2,000 futures contracts, that's 10 million ounces of paper silver, get dumped on the market. This happens during the empty hours, when there's almost no one around to buy. You don't do that if you're trying to get a good price. You do that if you're trying to shove the price right off a cliff.
And that overnight ambush, it created this massive chasm. While the paper price in New York was just getting hammered, the price for real physical silver over in Shanghai was rocketing higher. You see that gap? $87 versus over $100? That $13 difference? That's not just a spread. That's a total market dislocation. It's like we're looking at two parallel universes, each telling a completely different story about silver.
So here's the thing. In any normal market, what would happen? Traders would be all over this. They'd buy the cheap silver in New York and immediately sell it in Shanghai for a massive risk-free profit. It's called arbitrage, and that action alone should snap the price gap shut, probably within hours. But it's not closing. And why it's not closing is really the heart of this entire mystery.
So why isn't that gap closing? Well, the reason is that the market is screaming at us that there's a serious physical shortage. Those traders can't just buy silver in New York because, well, they can't get their hands on the actual metal to ship it. And the loudest signal, the biggest clue we have, is something called backwardation.
So what is backwardation? It's pretty simple, actually. It's when the price for something right now is higher than the price for that same thing in the future. It's the market basically screaming, I want the metal in my hand today and I don't care about a paper promise for delivery tomorrow. People are willing to pay a premium for immediate delivery because they're genuinely worried they won't be able to get it later.
This is a perfect analogy. Imagine trying to get a ticket for a sold-out concert tonight. Scalpers are charging $500. But a ticket for that same band's show next year, only $300. That extra $200 for tonight's show? That's backwardation. It's pure urgency. It shows a complete lack of faith that you'll be able to get what you want tomorrow.
And this brings us right back to that $13 price gap. The second big clue is that the gap is still wide open. And the reason is painfully simple. You can't buy and ship something that isn't for sale. The arbitrage trade isn't happening because the physical silver in the Western vaults just isn't available. Either they don't have it or they're flat out refusing to release.
Okay, so we've got the clues, but what's the motive? Why would someone intentionally crash the paper price? Well, it looks like we're watching a full-blown war between some huge financial players and the simple, hard reality of physical supply and demand.
Just look at this chart. It tells you everything you need to know. Silver gets hammered, down 5%, but gold, it barely even blinked, down less than 0.5%. This wasn't some big market-wide event where everything went down. Nope, this was a targeted, surgical strike aimed at one thing and one thing only: silver.
So why single out silver? The leading theory is that it's all about a looming gamma squeeze. See, there are some very large banks who have bet big that the price of silver will go down. They're short silver. And they are apparently desperate to keep the price below a certain key level, because if they don't, a catastrophic chain reaction could be set off by options that are expiring this Friday.
So this gamma squeeze thing, it's the feedback loop from hell for anyone who's short. Here's how it works.
First, the price crosses a critical level. In this case, the $80 strike price for the big silver ETF. Once that happens, step 2 kicks in. The market makers who sold those options are suddenly forced to buy millions of ounces of actual silver to hedge their positions. And that leads to step 3. This massive wave of forced buying pushes the price even higher, which triggers more forced buying, and you get this explosive upward spiral. That overnight price dump? It was almost certainly a desperate attempt to prevent step 1 from ever happening.
So here's the big question. Was this a healthy market correction? Or was it a deliberately manufactured attack? You know, when you actually lay out all the evidence side by side, it really starts to point in one very clear direction.
All right, let's play devil's advocate for a second. The skeptic would say, hey, this is just a normal 5% correction after a huge run-up. You're just seeing conspiracies where there are none. And you know what? On the surface, that sounds perfectly reasonable. Markets need to pull back. But when you actually look at the specific data from this event, that whole healthy correction argument just completely unravels. Let's just compare. A healthy correction? It usually happens during normal liquid trading hours. What happened here? A massive dump in the dead of night. A healthy correction is usually triggered by some kind of big economic news. Here, there was zero news, and gold was totally flat. And finally, in a correction, fear usually dies down and the futures curve goes back to normal. Here, fear exploded, backwardation got worse, and that massive $13 arbitrage gap is still sitting there. None of this lines up with a healthy correction.
So what should we be watching now? There are 3 critical signals. First, that $80 level for the SLV ETF. Does the price manage to close above it this Friday? That's the big one. Second, keep an eye on that Shanghai premium. Does that $13 gap get even wider? And third, watch the backwardation. Does it keep growing? These are the data points that are going to tell us if this paper dam is about to burst. It all comes down to this one question, doesn't it? When the paper price on a screen and the physical price in the real world are telling you 2 completely different stories, which one do you believe? What's the real value of something? Is it just a number in a database, or is it what someone is willing to pay to actually hold it in their hand? The next few days are going to be absolutely fascinating to watch.